let me just on one point that I'm glad you brought up 2008. When that happened, when the price fell from 1,000 to 700 in gold and 21 to 9 in silver, what was very interesting in my market was that there wasn't an ounce of gold or silver to be found for the second half of the year anywhere. I thought we were going out of business, and I'm dead serious. In 2008, the U.S. Mint shut down a half a dozen times. The Perth Mint in Australia ran out of product for the first time ever, took no new business after August. The Rand Mint in South Africa was cleaned out. One wealthy Swiss businessman flew a 747 there and cleaned them out for the first time ever.
Something big has just shifted in the global financial system, far bigger than anything mainstream media is willing to admit. Japan, a nation that has been one of America's most reliable financial partners for decades, has quietly pushed back against U.S. pressure. They are now unwinding more than $1.1 trillion in U.S. treasuries, contributing to one of the weakest bond auctions seen in years. At the same time, COMEX silver inventories are draining at an alarming pace. Backwardation, usually a rare signal, is becoming persistent, suggesting real physical shortage. And behind closed doors, central banks worldwide are buying gold in quantities that never make it into official reports. These are not normal indicators. These are warning signs that global trust in the dollar-based financial system is beginning to fracture. Andy Schectman, one of the most respected wholesalers in the precious metals space, says the patterns we're seeing today feel hauntingly similar to 2008. But the difference now? The scale is far larger, and the vulnerabilities are deeper. From weakening treasury demand, to disappearing physical silver, to silent, strategic gold accumulation, the world's most powerful financial players are positioning themselves for a major reset, while the public remains completely unaware. In this video, we break down what has changed, why it matters, and what these signals mean for anyone holding dollars, stocks, or paper-based assets in today's unstable environment.
The Canadian Mint, the Australian Mint, and the Canadian Mint, the Austrian Mint, and the UK Mint were working 24 hours a day, 3 shifts, 8 hours apiece, and they were as much as 12 or 14 weeks backordered across the board. And nobody, I mean nobody, sold anything. I am a authorized reseller of the U.S. Mint. They said, we will take no orders. We'll let you know when you can take it. And when they finally came back online, months and months later, into the fall, right around this time, they said, fine, we'll take your silver maple leaf order or your silver eagle order. With $9 silver, you're going to pay 18 or 19 bucks, and you're going to wait 8 to 12 weeks to get your product. You got to pay up front. And the same thing was true with gold. What I'm saying is it was a paper-derived smash-down drive-by shooting. And if you do that now with naked shorts when silver's in backwardation and the exchanges are being bled dry, that's exactly the environment that these traders across the globe are going to jump all over and say, fine, we'll stand for delivery. Where's the product? And that, to me, is an existential threat. And I wonder, is it true to you that the only way to manipulate a market is to push it in the direction that it is going? But when you throw in the delivery ability to stand for delivery, like we're seeing in silver and the chaos that's creating in both physical silver and in SLV, I don't know. I think it's something that these traders would need to think very, very cautiously about, because I can tell you in the physical world, there was not one person that sold anything and the price just cratered. So I don't know. It's nuanced for sure, but again, could it be different this time? Don't know. It feels it to me in my gut, but I defer to you guys. You have the career in technical analyzing these markets, and I respect that. Yeah, I mean,
Andy.
yeah. Well, I mean, look, I look at what's going on with the carry trade. You got Japanese pension funds pulling out 1.1 trillion out of U.S. Treasuries now because keeping money in America loses them money after hedging costs. And when you have Japan stop buying, interest rates wouldn't just stay flat; they would arguably explode. And and I think that's the issue. When you have 1.2 trillion in borrowed yen funding crypto stocks, emerging markets, all this stuff has to unwind. And every hedge fund, every momentum trade, every leverage bet built on free Japanese money is getting margin called. I think it is a very important trade. And I don't know, December 18th is a big day for Japan. There's a 50% chance they hike again. So what happens then? I guess you could say the world's biggest piggy bank just got smashed a little bit. I don't know. It seems that way to me. It seems big, very big, and I would agree that it's probably bigger than people think. It's interesting because the public is really hasn't been a massive participant in the gold rally. It's been more along the lines of the central banks and whoever the heck is importing billions upon billions every month into COMEX, the sophisticated traders. Maybe it's some of the people listening to the chief investment officer of Morgan Stanley who said sell half your bonds and put 20% into gold, or Michael Hartnett from Bank of America who said no, make it 25%. Or Jeffrey Gundlach, who said, no, 25% is not overweight. Things I never, ever thought we would hear. I think the public is behind the curve. And if you look at the recent data, they're all in the stock market, highest ever, largest margin debt ever, largest option exposure ever. The public's in the market. The big money, the central banks, the commercial banks, the sovereign wealth funds, they're the ones that have been driving not only the gold accumulation, but the deliveries off of the exchanges. So I think the public is the last one to get involved, and really, other than some very large orders by people who are paying attention, I would say the public at large is not involved in this market hardly at all.
Andy, can I ask you a question? Do you mind if I ask you a question? Just to that end, interestingly, I think when retail really did try to get involved was when people were lining up in Australia and it was at that local top, right? So we saw that on the news, and I think that's classic market behavior. What do you think it would take for the classic 60-40, the RIAs in the world to finally decide, hey, we need some sort of allocation to precious metals, a 60-35-5 or a 55-5-50, whatever it would be? It seems very strange to me that even with this massive move on gold, you don't hear people advising retail to put it in their portfolio.
Yeah, it's strange to me too. I mean, maybe it's just been so whitewashed out of the ecosystem that they don't think about it. I mean, one of my very best friends is manages $3 billion for Morgan Stanley here in Boca, one of the biggest in the state. And he wouldn't know a gold coin if it fell on his foot, yet their chief investment officer is saying put 20% in gold. So I don't know. I think typically, and maybe this is why there's the whole theory of Elliott wave and Kondratiev wave theory, human emotions that drive the market. I think maybe they have to see it with their own eyes. But, people who are successful, I think, move before the trend. And that seems to me to be the central banks who've been doing this for the last 8 years, and now the sovereign wealth funds, and now the commercial banks. So I don't know. Maybe it just is validation they need to see with their own eyes instead of doing what the biggest money has been quietly doing for quite some time. And you look at how gold has performed. It's really done amazingly well and it's outperformed most assets. The fact that it hasn't been embraced, I don't know. It's a mystery to me, quite frankly. But I would think that it has to be validated by people's own eyes before you see anything substantive with the public or the local money managers or financial advisories.
Subscribe now for more deep dive financial insights every week.